Thank you very much for those, Vonnie. Elsewhere, Amazon is raising at least $25 billion in U.S. bonds to fund its AI spending, which Bloomberg Intelligence says could top $300 billion of capex next year. Let's discuss with Bloomberg Intelligence credit analyst Robert Schiffman and Bloomberg Tech host Ed Ludlow. Robert, on this deal, not every day, I'm exaggerating. It feels like we have some hyperscaler coming to this bond market and tapping it. And for the most part, maybe we put aside SpaceX, the market absorbs it. How far can these companies take it? How far can they increase their leverage before we start looking at things like credit downgrades?
I think you better get used to having me on set because we're going to see a lot more of this.
Which is a treat,
You could just ask, Robert.
We have said this over and over again. The biggest hyperscalers I would consider to be on the Mount Rushmore of credit. These are AA and AAA names that have hundreds and hundreds of billions of capacity. Somebody asked me this morning, what would it take to have one of these names go to junk? You're talking a number that would be, I think, over $1 trillion. Wow. So I just think that what we're seeing here, supply continues to fall well behind demand. Spending is going up. And the only way to spend is to borrow more money.
Do they borrow at fixed rates, or what happens if the Fed does have to hike a few times?
Yeah, well, primarily all this extended duration borrowing is all fixed. So now you're locking in costs for 10, 20, 40 years. Remember, Alphabet did a 100-year bond via pounds a few months ago. So you don't have to worry about rates necessarily going up, other than why not borrow now if you think rates are going up? It's actually an incentive to come to the market sooner rather than later and lock in these deals.
Ed, that's the debt side. For how long can the equity side hold up? Because there does seem to be this narrative emerging saying you need to have a return on this investment. You can't keep spending without any fruition coming from it.
The equity side is much more closely tied to, is Amazon or AWS in particular good at AI, right? And they've kind of demonstrated in more recent history that they are, or at least the market gives them credit for it. You know, the thing about what Schiff outlines in the Bloomberg Intelligence React, I find fascinating, which is if CapEx is going to be $200 billion this year, why would it jump to $300 billion next year? And the way that Amazon explains it away is not necessarily that you have to keep building data centers to meet with that AI demand. CapEx can also go up because the cost of building data centers goes up, right? That has nothing to do with AI at all. There is construction labor inflation. We know there is great memory price inflation still, right? We're very focused on this idea that memory supply is tight. Continue to look at memory pricing. And so that was so interesting when he published the React. And the thing about it is that Andy Jassy tried to explain that in the prior earnings call, April 29th. They said it several times. Capital expenditure growth is outpacing revenue growth. And so to answer your question, we still don't see that accelerating AI revenue growth at a level where you're like calm about it on the equity side.
But every time we see something that's going to interfere with this cost, isn't it going to jolt the market? Like, for example, when NVIDIA said there was going to be a delay with its server racks.
Well, NVIDIA didn't say it. SemiAnalysis said it. Okay. And NVIDIA came out and pretty robustly rebutted it. You know, the reality is right now is that there is a big distinction in the markets between the capital expenditure deployers and the capital expenditure recipients. The recipients, for the large part, are the chip makers. And somewhere in the middle, to Danny's question, is show me something, a real tangible metric that shows you are making money from AI. And in Amazon's case, they can point to AWS top-line growth, but they also have this metric which they will call AI revenue run rate, which is basically all of the things they do sort of linked to AI packaged as one thing. It can be people running AI workloads on their cloud compute capacity. It can also be the training of models and then the deployment of those models, inference. The reality is that they're still supply constrained on the compute side. So while that activity ramps, they also have to build more data center to accommodate for it. It's just the math on that and the cost of it. It's fluid and changing all the time.
Robert, what's made SpaceX different? This is a debt that has been trading lower, that has been largely disappointing to the market. Why hasn't that been as well absorbed as the rest of the hyperscalers?
Well, they're not part of the Mount Rushmore of credits. You know, SpaceX is a BBB name that doesn't have a real...
Pretty good.
It doesn't have it's high grade, but it doesn't have a very long history of generating any profits. So it's negative free cash flow. People are wondering how much funding it's going to take over the next handful of years. And because you have such key man risk, what does he actually even want to spend on? When you look at SpaceX mission, it scares people about talking about raising interplanetary experiences. So I think a lot of that is just sort of hype. But there's a difference between BBB and BB hyperscalers that are building data centers that need to borrow money versus these very well capitalized, low leverage names that generate tons of profits in other businesses that can help finance the build out. And listen, from the equity side, just remember, I actually think that this is a positive sign from Amazon versus issuing equity like Alphabet did a few weeks ago. Because the weighted average cost of capital suggests you should issue a lot more debt. But also, I think the leaders of these businesses, I'm sorry to say this, I don't think they care about their equity price right now. If they cared about their equity price, they'd be cutting CapEx.
But doesn't a robust equity price allow them this cheap cost of capital? I realize the bond markets are still holding up, but doing things like issuing equity, isn't it important for them that they continue to see rich value?
Well, like a completely separate case study is Rivian, right? That is just being opportunistic because in the 5 days since they had delivery numbers, the stock went up significantly, but like relative to basically the stock went up and they're like, you know what we should do, guys?
Dilute.
We should do an offering and raise some. And they did, but that's different spectrum,
Sure.
To other end of the spectrum to Alphabet. Sorry, I just was like,
and then on top of
crazy.
Listen, SpaceX raised $85 billion of equity. That cushion didn't provide that much backdrop to hold up bonds. They widened in the aftermarkets. I just think that spending is going up. It's not going down, and it's going up more than what the equity community wants to see. They want to see returns.
Right.
Well, wake up. You're not going to see them in big size for the next 2 or 3 years. You're just going to see more spending, and we're going to be in this circular reference of when are we going to see it? They're spending more. Demand exceeds supply. And what does that mean? It means more question marks, more volatility. From the credit side, though, these credits are fine. There's tons of capacity. They can do it at super low costs. And bondholders are willing to fund this because they know over time credit quality is very likely to hold up.
All right. Thanks to Robert Schiffman of Bloomberg Intelligence. And also, of course, Bloomberg Tech host Ed Ludlow.